BlackRock has just discreetly repositioned trillions of dollars in assets, and this monumental shift is barely making headlines. I'm not referring to market speculation or alarming clickbait articles. I'm pointing to the actual movement of trillions in tangible capital happening right before our eyes without widespread notice. This particular strategic maneuver indicates the beginning of an enormous transfer of wealth globally. In this presentation, I will reveal precisely where those funds are being redirected, the reasons this is occurring at this very moment, and how everyday investors such as ourselves can strategically align our portfolios before this transition becomes common knowledge. Presently, 3 significant economic transformations are unfolding across the world. To assist you in capitalizing on them, I will analyze 3 particular exchange-traded funds and 1 international rotation tactic that the majority will overlook entirely until the prime opportunity has already passed. We must first grasp the sheer magnitude of the entity involved. We are discussing a firm that oversees $14 trillion in assets. BlackRock is far more than a hedge fund. It is not a content creator with a mere intuition. This institution stands as the biggest asset manager on earth. Consider this analogy. If the stock market were an apartment complex, BlackRock would be the property owner. They hold a stake in virtually every major asset. Their influence is in your 401k plan. Their presence is in your pension fund. They are ubiquitous. Therefore, when BlackRock chooses to reallocate its capital, it is not merely taking a guess. I assure you, Larry Fink possesses insights far beyond our own. This decision is not rooted in sentiment. It is grounded in quantitative analysis, it is driven by policy directives, and it is calculated on probabilistic outcomes. Let's examine the factual situation. In recent activity, BlackRock shifted $2 trillion in exposure away from the United States and reallocated it toward emerging international economies. That is correct. They extracted $2 trillion from the American financial system. Now let's pause. This does not signify an imminent collapse of America. However, it undeniably signals that investment returns are entering a rotation phase. Capital moves like a current. It perpetually flows toward the areas offering the most accelerated growth. Observe that individual retail investors, which includes us, typically respond to news stories. We observe market updates, experience fear, then sell, or we become enthusiastic and purchase. Our behavior is reactive, but large institutions, they act before the headlines are ever published. They possess this capability because they employ legions of analysts conducting profound research that we cannot access. They utilize data sets worth millions of dollars. Yet, here is our strategic advantage. We do not require their proprietary data. We simply need to observe their actions. We must monitor what they physically do, not merely what they publicly state. In truth, moving $2 trillion is not a logistical challenge for an entity like BlackRock. But if you are unaware that this capital is being moved, you are navigating without a compass. By the time financial networks like CNBC or Bloomberg interpret this trend for their audience, the trend is already saturated with participants. The substantial profits have been realized. Thus, the crucial inquiry is not, is the U.S. market performing poorly? The essential question is, where will the next wave of growth originate? Financial markets do not reward allegiance. They are indifferent to your fondness for American equities. Markets reward correct positioning. This is precisely why the 3 ETFs I will present are so potent. However, before we examine the specific tickers, it is vital you comprehend the underlying mathematics. Listen carefully to this next segment. Let's briefly scrutinize the performance figures. In the previous year, the US dollar depreciated by a considerable margin. Reflect on that implication. It signifies your purchasing power diminished. Even if your stock portfolio's value remained unchanged, you effectively lost wealth because each dollar you hold now buys fewer goods. Investors despise this erosion. They seek to preserve their buying capability. Consequently, they search for assets that deliver the optimal return for their currency, regardless of those assets' geographic location. Observe the performance scoreboard from last year. Germany's stock market delivered approximately a 22% return. Japan's markets yielded about 26%, and international markets collectively returned close to 30%. Now examine the S&P 500 index. It returned roughly 16%. A 16% gain is positive. We appreciate profitable returns. While it is not the commanding 30% witnessed in prior eras, it is acceptable. Nonetheless, when you survey opportunities beyond America, you recognize you might be missing potential gains. Here lies the strategic advantage. When the US dollar weakens, international assets receive an additional uplift. We term this a tailwind. Imagine running a race with the wind pushing at your back. You achieve greater speed without expending extra energy. When you invest in foreign markets during a period of dollar weakness, you profit not only from the appreciation of the stock itself, you also gain because the foreign currency strengthens relative to your dollar. This constitutes a dual return. You succeed on 2 fronts. This strategy is not about deserting American equities. Please refrain from liquidating your entire portfolio. That is not my message. This is about prudent diversification. It is about acknowledging that economic leadership on the global stage is transitioning. My goal is simply for us to be observant. I want us to identify the wave before it breaks over us. We are not attempting to forecast the future. We are striving to position ourselves where capital is flowing. We are merely paying attention to the factual reality. Allow me to be explicit. America will undoubtedly continue to innovate 100%. We will maintain our dominance in technology. We will continue to lead in defense. We will remain at the forefront of artificial intelligence development. However, large-scale capital, significant money, is unconcerned with past achievements. It is concerned with future velocity. And currently, capital is seeking a new residence. It is searching for safer havens to reside within. Consider the political environment. The presence of Donald Trump introduces unpredictability for markets. He represents a variable. I am not discussing political viewpoints here. I am addressing market certainty. Financial markets abhor uncertainty. And presently, the political climate is generating apprehension. That fear propels capital outward. It migrates to regions where growth is accelerating, not where the highest growth has already occurred. We are currently witnessing a convergence of factors. We have policy-related risks, we have currency valuation pressures, and we have enormous sums of capital exiting the established system. Last year alone, $48 billion in foreign capital departed the United States. Let that figure resonate. $48 billion. That capital collected its belongings and departed. So where did it go? And more critically, where should you position yourself? Here is the dilemma most investors encounter. You understand the necessity of diversification. You desire to capture these explosive gains available overseas, but you are uncertain which specific country to select. Choosing incorrectly results in losses. I will demonstrate precisely how to resolve this using a straightforward basket approach shortly. First, however, we must examine the initial major participant in this shift. The primary ETF on our radar is VWO. This is the Vanguard Emerging Markets ETF. VWO acts as your passport to the world's most rapid growth engines. It provides exposure to economies like China, India, Brazil, and Taiwan. Why is this significant? Demographic trends. These nations possess youthful populations. Young individuals join the workforce. Young people consume goods and services. Young people construct societies. In the United States, our population is aging. In these emerging nations, the labor force is just commencing its expansion. Last year, VWO delivered a return of approximately 25%. That is a substantial gain. This year, its price activity has been considerably calmer. Yet for a strategic investor, calm conditions are beneficial. Stability is an advantageous characteristic, not a flaw. Institutional investors do not frantically purchase stocks during vertical price surges. They accumulate positions during quiet periods. Consider purchasing VWO at this moment, akin to investing in the U.S. stock market 2 decades ago. This is not a short-term trade. It represents long-term exposure to the next group of global economic leaders. Now let's evaluate the second ETF. This one often surprises individuals. It is EWJ. This fund tracks the Japanese market. Observe its performance metrics. It recently experienced a massive rally, up 71% at one point this year and returning 24% over the previous year. Now pause. I comprehend your potential skepticism. Japan? Isn't Japan's economy stagnant? If that is your belief, you are mistaken. You are considering the Japan of the past. The new Japan is undergoing a profound structural transformation. They are reforming corporate governance standards. They are emphasizing operational efficiency. They are finally prioritizing returns for their shareholders. That translates to generating profits for investors like us. Additionally, the Japanese yen is currently weak. When a currency is weak, that nation's export goods become less expensive for the global market to purchase. This operates as a profit engine for Japanese corporations. Institutional players adore this configuration. You have a stable government structure, you possess globally recognized brands such as Toyota and Sony, and you have a currency tailwind amplifying corporate earnings. This is not merely a recovery narrative. It is a comprehensive reset of their entire business methodology. Perhaps you prefer not to concentrate your investment on a single nation. Perhaps you desire exposure to the entire assortment. This leads us to the third ETF, EM. EM is a broader emerging markets fund. It achieved a 34% return last year. This is the instrument institutions employ when they wish to make a macroeconomic investment. They are not betting solely on Brazil or solely on India. They are wagering that the collective global economy will expand more rapidly than the United States, and currently that is an intelligent wager. Regions like India and Singapore are experiencing exceptionally rapid growth. If you believe worldwide growth is poised for an explosion, you invest in EM. It distributes your risk across multiple economies. Now, it is crucial you understand the underlying psychology. When you encounter headlines concerning market sell-offs or political discussions about acquisitions like Greenland or drama at global forums, resist panic. Do not begin frantically clicking buttons and liquidating your holdings. The average person panics. Large institutions strategically reposition. Understand, capital never truly exits the market entirely. It merely relocates. It moves from one table to another. Market pullbacks are frequently just major players transferring their chips to a different game. And here is the fundamental principle you must remember. Every major global rotation feels uncomfortable before it becomes glaringly obvious. I will reiterate that. It feels unnerving immediately before it becomes apparent to the entire public. Yet there exists a trap, a critical error that 90% of investors commit during a shift of this nature. They hesitate, they await certainty. They wait until conditions appear stable and the news is positive. But I will explain why waiting is the most direct path to remaining financially stagnant and what the genuine signal from sophisticated capital looks like at this juncture. Here is the uncompromising reality. Certainty is the most costly commodity in finance. Certainty only materializes after the most substantial returns have already been captured. By the time the environment appears clear to you, the major institutional players have already departed. BlackRock is not predicting the future. Larry Fink does not possess a crystal ball or a time machine. He operates on probabilities, and this is the single factor that overwhelms the typical investor. You are waiting for safety. You are waiting for the news to declare that everything is favorable. But institutions, they are responding to currency fluctuations, policy modifications, and growth metrics in real time. If you wait for the unequivocal all-clear signal, you are purchasing at the peak. Does this imply you should sell all your US stocks? No, absolutely not. I would never advise you to operate from a place of fear. This is not about fear. It is about awareness and strategic positioning. You do not abandon the United States. You must simply identify the correct sectors within it. I have previously discussed defense stocks. They are demonstrating resilience. I have highlighted rare earth minerals. They are experiencing a boom. I have pointed to industrial stocks. These represent secure harbors. However, ignoring a global rotation while the planet's largest asset manager is relocating trillions of dollars, that constitutes the genuine risk. You are not required to predict the future. You simply need to follow the footprints left in the sand. Establish your position early, remain patient, and allow the systemic shifts to execute their work. Yet another transformation is occurring behind the scenes that you must understand. It involves precious metals, specifically gold and silver. This is not merely about their market price increasing, it concerns a fundamental alteration in the financial rules of the game. Recently, gold and silver have undergone an effective reclassification. For decades, major banks viewed gold as an inert, shiny commodity. It was pleasant to own, but offered limited utility. It was considered dead weight on a balance sheet. Now, however, gold is being treated as a core Tier 1 liquid asset. Here is the plain English explanation. Major banks like JP Morgan and Goldman Sachs can now account for gold as if it were cash itself. They can utilize it as collateral to secure loans and employ leverage on massive sums of capital. Previously, they could not do this. Suddenly, gold is not just a safety asset. It has become a financial instrument of significant power. And what do you suppose occurs when the world's largest banks realize they can use gold to effectively create more capital? They acquire more gold. This is a primary reason we are observing record-high prices. The movement is not driven solely by fear. It is driven by newfound utility. And here is the critical connection. BlackRock influences your 401k. These strategic moves, including the gold reclassification, impact the value of your retirement savings, whether you personally own physical bullion or not. This is how the financial game is conducted. They modify the definitions, they reposition the assets, and they execute these changes without sending you a personal notification. So how do we manage this? How do we maintain composure when the global landscape appears volatile? You must comprehend the panic-inducing playbook. We have observed this sequence before. We witnessed it during the prior Trump administration. We know the general conclusion of this particular episode. Notice an intriguing pattern. Significant negative news is often released during weekends. Why? Because the financial markets are closed. The design is for you to spend 48 hours at home, absorbing anxiety, reading alarming social media posts. They intend for you to be terrified by Monday morning, prompting you to sell your holdings at depressed prices. Then the market opens, a brief decline occurs, the weekend's fears are absorbed, and Tuesday arrives. Headlines may feature international tensions and combative rhetoric. The situation feels confrontational, but then quietly by midweek, rumors emerge. Negotiations are commencing, discussions are described as productive, and what is the result? The market experiences a rally. The perceived crisis dissipates. and the institutions that purchased the shares you sold in a panic on Monday are profiting substantially by Friday. This is a game played deliberately on the emotions of the public. Observe that, once again, we have not received specific legal details regarding new proposed tariffs. This is not a coincidence. Vagueness is maintained intentionally. They desire the uncertainty to persist. However, if you understand the established playbook, you need not be the casualty. You can position yourself to be among those who profit. Yet there is a final component to this puzzle. There exists one specific market sector that prospers amidst this type of chaos, and it is the sole area where I am currently deploying new capital. The financial market's design is to hijack your emotions. It is engineered to keep you in a state of overstimulation. The algorithms, the flashing red numbers, the breaking news alerts, they all aim to create a traumatic relationship with your capital. I do not want you to glance at your account, observe losses, feel your heart rate accelerate, and then liquidate everything merely to cease the emotional pain. That is precisely what the system anticipates you will do. That is the mechanism by which wealth is transferred from your account to others. You must resist the compulsion to react impulsively. Calm yourself. Close the trading application. Seriously, shut it down. Take a deep breath. Conduct your analysis. Return when you are focused and rational, not when you are driven by fear. However, understanding not to panic is only 50% of the battle. You need to know precisely what assets to acquire when everyone else is immobilized. I referenced a specific sector earlier that excels during exactly this brand of global instability. It is not the technology sector, and it is not real estate. This sector has historically outperformed the S&P 500 by double-digit percentages whenever geopolitical tensions escalate, and institutions are currently funneling billions into it. I have analyzed the top 3 stocks within that precise sector in the video linked right here. The strategic setup is ideal, and the window for early entry is rapidly narrowing. Select this video, and I will provide you with the specific ticker symbols.